All right, guys. Well, markets, they sold off a little bit in the last week or so. And we're hearing a lot of news about this being the post election kind of hangover where all those great expectations got bitted up and now reality's starting to kick in. And I wonder, are we just seeing a little bit of profit taking here? Or is the bottom line like this is over? We had that post election pop and the party's done. That's it. Time to put your money in cash and wait for the big storm to come. What are your thoughts?
Well, I'm having a hard time personally handling a down week.
Well, Bob, you do seem emotionally distraught. I'm not going to lie. I can tell one hair is out of place. That's when you know that things aren't great.
I mean, if this has been a hangover, I'm truly disappointed because I feel like I should be sleeping in rather than working. But, and talking to a lot of my clients, I mean, the sentiment is so different across the board. People that are pro-Trump, people that are anti-Trump, the anti-Trumpers are saying, well, this is exactly what's going to happen. He gets in, the market's going to go down. The people that are pro-Trump are saying, no, this is just the beginning to a great run up. So who knows?
I think what is fascinating is the fact that the Fed is now lowering interest rates again, and they're expected to do this again next month. Yeah, so that means your money markets are paying less, but more money keeps going in cash. I would say that's probably the one thing that's actually keeping this markets from going higher is how much money is sitting on the sidelines right now, which is pretty crazy.
Yeah, and you couple that with 8 trillion on corporate balance sheets right now. Like that's a lot of money for dividends, stock buybacks. So we're just, one thing that's really hasn't changed is the world is still awash in cash, right? I mean, even with the Fed raising interest rates like they did over the course of like 2 years, bottom line is like there's so much money out there still. And that probably speaks to the fact that this wild animalistic bull market, probably isn't over yet.
Well, you know what? I'll trash the analyst before Ryan does. And, for the last 2 years, they kept telling us about the hard landing, how bad it's going to be. And now it's like, oh no, everything's fine. Geopolitical risk, that's nothing. Throwing missiles into Russia, don't worry about it. The CPI didn't go down, it went up. That's not a big deal. Bond yields are rising. Don't worry about it. This is a big boom and bull market. It's everything's coming up roses. So it's incredible how quickly they change. I think they make their projection based on whatever the market opens up at that day and project it forward.
I think I like that strategy. Maybe we should start looking at that.
What do you mean, Chris? You don't know about my yield to noon strategy?
I always wonder what that big coin was on your desk. I didn't realize you were flipping it every morning.
Well, that's a funny thing too, is right. I mean, if you look at a chart, you look at the markets. I mean, they barely have sold off, right? I mean, in context of how much markets have gone up here, it's a needle in a haystack. So, I think from that perspective, if you look at things, is we're not really getting big corrections or sell-offs here. And I think that's what a lot of investors are waiting for. Like, I'll get my cash to work when we finally get that big sell-off. And, as Bob likes to say, bull markets, they just don't let you in.
Well, Ryan, a lot of these pundits, they keep increasing their price targets, right? They were all at 4,800 for the S&P 500. And by the way, it's at 6,000 or, 5,900 after last week's correction. So now they've increased that bold projection to 6,100 by year end, which is, of course, less than a month or a little more than a month away. But I heard you going out there making $7,000 S&P 500 projections. What's up with that?
I like to be bold, Bob. But, if you look at, if this is like the dot-com bubble, and if you start looking at some of the data, it's starting to look a lot like that, right? If you look at the forward price to earnings, not to get wonky, on the S&P 500, right, it trades relatively close to the valuation it did back in 1999, 2000. But if it trades all the way up to that same valuation, you're looking at 7,000 on the S&P 500. And I suspect because so many strategists and analysts are pushing their projection to 7,000 all the way at the end of next year, you'll probably get there quicker just because the market likes to do the opposite of whatever people are predicting. So I think there's a good chance here. And again, talking about all that cash on the sidelines, that could just keep ramping this market up in the short term.
And when you talk about, Ryan, how expensive the markets are, right? So you're saying it's as expensive as it was back in the dot-com bubble. This is kind of interesting because this is why, as a firm, we don't just put money into the S&P 500. You can basically split this in half. So half of those are your growth companies, and that's what's trading a lot, like 28 times earnings compared to like 22, which is its 5-year average. Then you take the other side, which are your dividend payers. Those are paying like 17 times earnings, so significantly cheaper. This is why we actually own both of these, because your growth company is doing really well this year, but the value company is probably a good buy, and this is why you actually want to own both those separately take advantage of the ups and downs in each of them.
Chris is taking notes.
Actually, I met with a client recently, and we were reviewing the performance of their portfolio, and it turned out that the majority of their returns at this point is predominantly coming from their interest and dividends. And just for some clarification, they are retired, and they said to me, "Wow, that's really not that great. We were hoping for a little bit more growth. We were hoping that more of the return would come from the growth side." I said, "Well, what if it was down 40% last year? How would you feel about that?"
Yeah, we can handle it, Chris. It's not a big deal. It's no big deal at all, right? I've been through these corrections before, but we know emotionally it's very hard to deal with the downside. And one of these topics, I guess, or these things we've talked about for a while now, is it's great to have the portfolio that's working right now, but do you have the portfolio that's going to work over the next couple of years? And I'd argue most of us don't, right? Because a lot of what we see moving forward is, and the bond market's telling you, and we talk about this week after week, is there's a good chance inflation is going to be more persistent than maybe the Fed wants you to believe, right? They've basically said they're beating inflation. We're down to close, didn't get to their 2% target, but we're getting closer to it. But if you look at a lot of the policies moving forward and the fact that the economy is rocking, we could probably be contending with higher inflation. And as we know, you need a different portfolio in a higher inflationary environment. And I don't think most people are prepared for that.
That really fascinates. That whole idea fascinates me because you'll get calls now, my accountant owns Nvidia, or, my neighbor who used to live next door bought a really big house because he made a killing in Bitcoin. And, people try to think in terms and think of a portfolio as one idea. Like, I own this hot stock. Well, you have every dollar in there. What do you mean? Like every liquid dollar you have is invested in that idea? I mean, do you have any savings? Do you have money in the bank? Do you have money in bonds? So it's, people don't think in terms of portfolios. They just think in kind of a, singular, I guess, monolithic fashion, which is the wrong way to think. Generally, when you look at it, the impact is really not that huge, in the overall scheme of things, in terms of your total return over your lifetime.
Well, I can testify to the fact that, we know exactly how people are invested. We look at something like 50 to different portfolios every month. And the reality is none of them are different. They're all the same. They have a ton of money in growth, Nvidia, S&P 500, and a ton of money in cash. It's like every portfolio I look at is a carbon copy of the one I looked at before. And I think that's a very clear indication about how people are invested.
We're talking a lot about what, is going to do well over our lifetime, the next 5 years, the next 10 years. But let's actually look at this year. We get really hung up on the growth stocks, which are doing really well this year. But Bob, you can attest to this. That is not our best performer in our portfolio, correct?
Right. Absolutely not.
It's our pipelines. I don't think a lot of people realize this, that our energy has actually been outperforming growth funds, and nobody talks about that. In fact, our clients have just as much of that as they do our tech companies, and it's doing better this year. And that's why you need to own all of these things, because you never know what is going to outperform, even the things that are hitting headlines right now.
And unlike growth, it also pays a big dividend.
Well, that's the thing. And that's a great point, Chris, because, look at it over the last 3 years. Over the last 3 years, it's outperformed everything. And, when we were adding to that, when it was out of favor, it was paying us 5-6%. And they've been increasing the dividend now every quarter. So, that's, you forget about those things. But even so, you look at the overall impact of the portfolio, it's not as important as every other aspect of the portfolio.
It's great when they're working, but when the music stops and you're concentrated in one place, that's what we call buzzkill. That can derail your whole retirement plan. Don't do it. Buyer beware. Stay diversified. Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. All right, so I thought we could talk about today, Bob and I were actually talking about this yesterday, is the greater fool theory, which basically suggests that one can profit from buying an overvalued asset by selling it to someone else at a higher price, assuming that there will always be a greater fool who's willing to pay more. And, you've seen a lot of these through history. You had the tulip mania back in the 1630s. We had the dot-com bubble, which was more recent. We had the real estate bubble, and then we had the meme stock bubble, which was probably the most recent. And arguably, maybe that Bitcoin phenomenon going on right now could be in that same vein, but I thought it was a good timely to start talking about where we're starting to see some crazy things happening in the stock market or in all sorts of capital markets.
Well, Rye, I know that anybody who's chasing Bitcoin right now or any other of the past manias would claim they would never buy a tulip bulb for the price of a home. But people did that, right? And we had it happen with gold. We had it with real estate. I mean, there was a period here in 2006 or in that area where people were buying 10 condos, on a new property because they knew they'd be able to flip them all to 100% profit by settlement date. So, it's, this manias that happen from time to time occur because markets never really change. They do change, rather. Markets do change, and the thing they chase changes. Human nature never changes.
No, it's a great point. And actually, I saw a stat today. There's this company called MicroStrategy. And this guy, Michael Saylor, he's just buying Bitcoin for the company. Everything they get paid and they convert it to Bitcoin, which is actually going up astronomically. But now this small little company, which I think is barely profitable with whatever they do business-wise, has as much cash on the books as like major companies out there, like IBM. It's insane. So it's just like things are getting a lot wilder right now. And we start looking at this stuff and the professionals start to make it seem like there's nothing abnormal about it.
Yeah, and Bitcoin's been interesting because this is something where, when you're buying a stock, you're buying a company, which as they make more earnings or they have growth in the future, the stock is worth more. But Bitcoin, it's not a company, right? So they don't have earnings, they don't pay a dividend. So it is that idea that the only way to make money is if somebody else can buy it for you at a higher price than you can buy it for. But there's been all these big catalysts recently. So now Bitcoins are in an ETF. So suddenly it became a lot more available and people started buying in. I saw this week they're now making options trades available on Bitcoin. So the speculative nature and the accessibility of it is getting higher and higher, even though the use case of it hasn't changed at all, which is pretty interesting.
And that's what I love about Wall Street. It's like we just love to open those doors and build the casino for you, right? And that's essentially what you're seeing right now is Wall Street's always happy to be there with the picks and the shovels. They might not be investing in Bitcoin because if you look at it, there's really no companies. Well, people always say to me like, well, BlackRock's getting into Bitcoin right now. They're actually not, right? They're not investing in Bitcoin. They're just building ETFs. So we can call them maybe quote unquote sucker retail investors will trade away. And that's how Wall Street makes a lot of money, right? It's just on people's transactions.
Well, I was listening to an interview with Jamie Dimon last night, and he said he thinks Bitcoin is ridiculous. He said, but you know what? If you want to buy it, we'll help you buy it. It's kind of like the old gold prospectors that went out west during the gold rush. The guys that made the shovels, that's where the real money was. They sold the shovels. That's where the real money was.
So true. But, it's everybody wants to invest like an institution, right? They want to invest like old money. They wish their family had a lot of money so they could invest like old money because then you don't have to get rich, right? You're already wealthy. All you have to do is grow your wealth at a reasonable level and preserve it, which is what everybody really needs to do.
Bob, didn't you write a book called Get Rich Slowly? I heard you didn't sell any copies, though.
I bought them all, baby.
Well, that is actually the truth, right? I mean, if you look at big money, people that have generational wealth, the money's managed very boring, right? Kind of like our strategy. It's very boring, but it works over time. And you're right. You always hear about, well, here's the secrets of what the rich do. If you really look behind the curtain, so to speak, it's pretty boring. It's not that exciting. And I think that's a big misconception. And it always gets pitched when these products get pitched on Wall Street, talking about a lot, is like there's something glamorous and something just like so amazing that no one else has access to, that only the rich has access to. And it's actually not true.
Well, I love to read the stories in the Wall Street Journal about, the janitor that left this university or this hospital $13 million because all they did was, save and live within their means and invest in stocks that pay dividends. It's never, oh, well, they put it all into this .com stock, or they put it all into palladium, or copper. It's, buying good quality companies that grow slowly over time, but it's that compounding, that makes the big difference. And, I guess Charlie Munger always said, never interrupt compounding intentionally. And of course, Warren Buffett did that last quarter. So I'm really worried about him.
Well, the funniest question I often get from clients and prospects alike is, well, this strategy sounds great, but I really want to invest in what's Bob investing in? What does Bob put his money into?
And that's the best part.
It's not Bitcoin.
No.
Yeah.
Well, the best part is we're fiduciaries, right? We have to invest your money as if it's our own. So there's nothing I own that every client doesn't own. And even better, I can't sell until we tell everybody. So it's, I love that. I'll be out in the golf course with a client, or out to dinner, or even in a meeting. So, Bob, my family, when you look at all the money we have with you through all the different trusts and, and all the different family members, I mean, is there anything special you do for me? It's like, how often do you look at my money? I said, how about like every second of the day, because I own exactly what you own. I know, and I love it when somebody calls up and says, oh, Bob, those pipelines were really down big this week. And I'm like, oh yeah, I didn't know that. I only own a ton, right? Thanks for giving a heads up. I'll go check my charts now.
I completely agree with you, Bob. And I don't know if you guys have seen this, but I am getting more and more questions about Bitcoin and just general cryptocurrency and how clients can invest in it and how much they should invest in it, more so than usual, because I think just that excitement and that hype, it is getting to people and they are hearing it. And that's always the first thing I tell them too, Bob, is no, I don't just not recommend it. I don't invest in this either, not personally.
Yeah. And the other thing too, Courtney, to that point, is that I feel like that fever also creates a little bit of investment amnesia, because the same people that are asking those questions, should we be more in the S&P? Should we own more Bitcoin? They completely forgot that in 2022, they were calling us saying, what do we do? Do we have to get out? We're losing all of our money. I want to be more conservative.
Well, that's the amazing thing, because if you think about it, like millennials, in all fairness, Court, that's your generation. You were probably too young. You weren't really invested during the great financial crisis. So you don't have the experience of how horrific that was. We remember how horrific it was because we actually started our firm then. And then you go back to the .com bubble as well. That's when I started in the business. So that's two big bubbles that have burst in my career. And you have Gen Z, millennials haven't experienced that. But my question is, what's the baby boomers' excuse? They've seen so many bubbles, yet they repeat the same mistakes over and over again. Because not just our younger clients asking about Bitcoin, it's our older clients that probably have made the same mistakes over and over again. What's up with your generation, Bob?
I spoke to a lot of my buddies who are into business and, own practices like we do and deal with high net worth individuals. And we're getting a little mixed message now. We're getting, some people think, oh, I haven't made enough, right? Well, you're up $1 million year to date. I am? Oh, I didn't think it was that. I thought I was losing. You're getting that question. And then you're getting, I think things are getting frothy. I think we better get to the sidelines and then buy the dip. Like who says there's going to be a dip, and who says, the market's not going to keep ramping higher? So I'm getting a mixed message in terms of sentiment from not just the investors that work with us, but the investors that work with my buddies.
Yeah, no, it's definitely, we always see the pendulum swing. And this is why we always talk about, you got to be prepared for anything that can happen. That's when you need to really reevaluate your portfolio and just ask yourself, if the market sells off tomorrow, am I protected? If inflation kicks back in, do I have assets in my portfolio that will go up? If interest rates continue to go higher, am I sitting in things like bond funds that we know go down and get rocked when that happens? So I think it's always looking at every scenario that can happen and making sure your portfolio can address, any sort of issue. It's the all-weather portfolio, and I think that's what most investors miss. They're either too heavy in one place or too heavy in another.
But isn't it the same clients who were calling you a year ago saying, oh my God, what are we going to do? The market's going to go down. It just keeps going down. I can get 5% in a money market fund. Aren't they the same folks now who want to get rid of that 5% treasury and put it all on red on Bitcoin or Nvidia or, whatever the hot stock or hot dot is that day.
Well, I don't want to mention Chris by name either, Bob, but he just can't help himself.
That 5% was just too attractive to ignore. It was like a fly to a lantern.
Yeah, well, you remember that too last year. Everyone was saying like, "Oh, cash is a position, right? Like that's a good place to put your money." And now that's underperformed everything. Those same strategists never mentioned that. They said, "Hey, have a good portion of your money in cash. That's an option now," which is kind of funny.
Yeah, but you know what, Brian? I noticed in your notes last week how much money is in a money market fund. Why is it going up? I don't get that.
Well, I think part of it is a lot of people are still sitting in savings accounts, which with the Fed cutting, they've gone even lower. So everyone's kind of rushing to get their money in the money market fund, but that's going down in yield too. So the question always is, when's that money going to the stock market?
Well, guys, I was talking to a client of mine recently, and they got a little bit testy with me. I recommended they had some cash. I recommended we get it in the market, spread it out across the portfolio. And they said, "Oh, great. Finally, we're going to put it in Nvidia or something in the S&P." I said, "No, some other places in the portfolio that are a little cheaper." And they said, "You know what, Chris, you never do what I want to do." And I said, "Yep. And you'd be broke if you did."
The first red flags are called Nvidia.
Yeah.
That's when that's like they don't have no idea what they're investing in. What this AI thing, I know we need some. But that's always the scariest part is a lot of us don't even know what we're investing in. And I think it's a bold Bobism. Good place to stop here is you shouldn't really invest in anything if you don't understand it. Just a great rule of thumb when building your investment portfolio for retirement. All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, from its IPO in early 1999 to the end of 2023, Nvidia investors enjoyed a 33% annualized return compounded, the highest growth rate for any U.S. stock with at least a 20-year trading history. If an investor had purchased $10,000 of Nvidia stock when it first became public back on January 22nd, 1999, that stock would have been worth $35 million as of the end of last month. Man, oh man, I wish I would have ridden that stock for the last 2 decades.
Well, it would have been great if you could pick the needle in the haystack, but the fact of the matter is nobody can guess what the best performing stock's going to be for the next 5 minutes, let alone the next 25 years. But the good news is everybody owns a piece of Nvidia. It's the largest holding in the S&P. It's the largest holding in every growth ETF, every growth mutual fund, every growth whatever is out there right now. It's all about Nvidia. But, just remember, what goes up often comes down, and sometimes it goes up on an escalator, but it comes down in the elevator shaft.
Well, I do recall, Bob, back in the late 90s, I was getting my financial advice from you, and the fact you didn't pick that one out for me, sorry, buddy, you're fired.
That's all right, Rye. I put you into GE.
That's why I'm still working. All right, Chris. Global military spending in 2023 was $2.4 trillion, up 6.8% year over year. The U.S. was number one with almost $900 billion in military spending. With all the geopolitical risk around the world, it makes sense. Everybody's spending more on the military.
Well, with a 40% of the global military spend, you shouldn't mess with the U.S., but also military spending is great for the economy, great for our defense contractors, and not to mention by a small margin, they're the largest employer in the U.S. by 27,000. I think they're almost tied with Walmart.
Wow, Chris. Do you have that stat on the top of your head, or are you chat GPTing it as we're speaking here?
You'll never know.
Hey, what's the over under when Elon gets done with it?
Oof, yeah, there could be some serious cuts to the government. We'll see. I'm skeptical that anyone can cut the government down, but you never know.
Some of those U.S. planes might have one engine instead of two.
All right, Courtney, the S&P 500 yield fell to 1.2% on Monday, its lowest in more than 20 years. Dividends have faded as tech stocks have accounted for a larger portion of the S&P 500. That is the lowest dividend yield since it hit 1.17% on February 12, 2001. That's right when the tech bubble burst. Tech stocks then also accounted for a big chunk of the index. Low-yielding mega-cap stocks are the antithesis of what an investor that needs retirement income should be owning. Providing no income leaves no margin of safety, especially if the market eventually sells off.
Now, Ryan, when you first started reading this stat, it sounded to me like companies are paying less dividends than they have in the past. But this is just a function of the fact that these big tech companies, which pay little to no dividends, are just a bigger portion of the S&P 500 right now. So there's actually still a lot of places you can go to get that high income when you're looking at high dividend stocks, you're looking at bonds, which have higher yields right now. So there's a lot of places you can go. It's just the S&P 500 is about like a third just those big tech companies right now. And that's what this is a function of.
Yeah, and it's starting to look a lot like the late 90s when we look at all these different metrics. It's kind of like Bob's hair. It looks the same. Back in 1999, he had the same hairstyle, and a lot of the S&P metrics now say that we might be, as we've been talking about, in a very bubblicious state.
Yeah, but guys, this is a lesson learned, right? If you keep the same hairstyle for 50 years, stocks go in and out of favor. So that means eventually my haircut's in favor.
Hey, and we know it's just one quick flip of the comb, Chris. Keep it right in the glove compartment of the car, and Bob's ready for business.
Well, you periodically have to rebalance your portfolio, as Bob has to periodically rebalance his hair.
No comb can get through this mop. You need a brush. Just be aware,
Yeah, it's true. Excuse me, a brush. It's always a brush, never a comb. Always a brush. Yes. Like high quality craftsmanship.
By the way, I'm marketing my own brush now. It's called Bob Brush, and you can buy it with Bob Coin.
If you sign up now, you'll get a free set of steak knives. All right. Another great episode of the Payne Points of Wealth. If you like our podcast, you love our podcast, give us that 5-star rating on iTunes. You can give us that 5-star rating on Spotify. If you love our content, please share our content. That gives us the support to continue to do this podcast. If this is on YouTube, you can like this episode. You can subscribe to our channel. Click that notification bell to be updated every week of all our new content. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.